not just everyone else's content that fuels generative artificial intelligence. The computer processing for AI requires powerful semiconductor chips. That need for silicon is in turn fueling what's expected to be the biggest launch of a new stock in 2 years. A microchip company called ARM has just unveiled to investors what they would be buying, the prospectus for its big stock sale. ARM is based in Britain but is owned by the Japan-based conglomerate SoftBank. ARM's initial offering of stock could shape the next leg of the artificial intelligence boom. Marketplace's Henry Epp joins me now.
Yeah, David. So ARM has been around for over 30 years, and it designs chips that make all kinds of things run: smartphones, PCs, cars. The company estimates 70% of the world's population uses devices with ARM technology inside them. But it's the potential of AI that could determine the company's future. You might have heard of another AI chip company, NVIDIA. They've been the high-flying tech stock this year thanks to their technology's support of ChatGPT. NVIDIA actually tried to acquire ARM a few years ago but was unsuccessful. And now the CEO of ARM's parent company says he wants to shift to offense mode on AI.
And as it happens, NVIDIA will report its quarterly financial results and outlook tomorrow. What are risks for investors trying to buy into this boom?
Yeah, well, for ARM, one thing is the sales of smartphones and PCs have really fallen off recently after a big boom early in the pandemic, and ARM's profits have dropped, but the company thinks the market is about to grow again. And then there's the company's sales to China, which made up about a quarter of their revenue last year. ARM notes that U.S. efforts to limit companies' sales of advanced technology in China could impact its business. And there's the fact that just not many companies have been going public. But since ARM's would be the biggest IPO in a while, if it's successful, other companies might follow suit.
Marketplace's Henry Epp. Thank you very much.
Thanks, David.
Sticking with chips in the news, a time of higher U.S. and China tariffs and the U.S. banning China's access to some American technology over national security concerns, China has also been thwarting some American tech ambitions. Intel Corporation of California recently scrapped a $5 billion deal to buy an Israeli semiconductor manufacturer, mainly because China seemed to slow walk regulatory approval for its market. Ali Budner has that.
Stacy Rasgon, a senior analyst at Bernstein Research, says Intel's semiconductor operations are global and multifaceted.
They make chips for PCs, the processor that's in the PC that's probably in front of you today.
And Intel wants to expand. Rasgon says Intel tried to buy the Israeli company Tower Semiconductor, but since semiconductors are a global industry, these kinds of business deals have to get regulatory approval from multiple countries.
You typically need approval from many jurisdictions globally, the U.S. and Europe and the UK and other places, and particularly China.
In a press release, Intel said it didn't get the necessary approvals before the deal expired. Now, Chinese officials didn't reject Intel's acquisition outright, Rasgon says.
They've just been sitting on it.
And sitting on it and sitting on it until eventually the deal died.
You only need to fail to get approval in one market, and then it can kind of put the kibosh on the whole acquisition.
Willie Shi is professor of management practice at the Harvard Business School. He says in the past, these kinds of deals were usually rubber-stamped with no problem.
Governments were more friendly to those things.
But with complicated geopolitics in the mix these days, he says it's harder. And the relationship between the U.S. and China, especially around high-tech and trade, is volatile. For starters, the U.S. has restricted China's access to semiconductors for national security reasons. China wants to respond, says Martin Chorzempa, a senior fellow at the Peterson Institute for International Economics.
But they've really struggled to find a good tool and a good way to do it.
Chorzempa points out that China has generally approved most international deals with no issue. Going forward, though, this might be the kind of leverage the country is looking for.
If they want to flex their muscles, they can really make it difficult for transacting parties.
And he expects to see China use this kind of roadblock even more going forward. I'm Ali Budner for Marketplace.
Markets Dow futures are up 0.2%, S&P futures up 0.5%, NASDAQ futures up 0.7%. Average 30-year mortgages are up quite a bit this week so far. Mortgage News Daily's average is up at 7.48%.
Marketplace Morning Report is supported by C3 AI. C3 Generative AI provides ChatGPT enterprise search that is verifiable, secure, and accurate across all enterprise data. Learn more at c3.ai. This is Enterprise AI. And by Charles Schwab. The people at Schwab are passionate about helping investors. Learn more at schwab.com/whyschwab.
Got a teachable moment about stocks here. Shares of the movie theater chain AMC lost nearly 1/4 of their value, 24% yesterday. A judge had earlier approved a complicated stock maneuver the company wants to do. AMC's trying to consolidate two types of its stock, AMC's plain old common stock and its preferred shares. The theater chain says the move will make the company more resilient after demand for movie tickets plummeted during high pandemic. Marketplace's Justin Ho explains.
AMC has been trying to issue stock to raise money and pay down debt, but the company hit a limit on how much common stock it could issue, says Stephen Davidoff Solomon at UC Berkeley.
So they hired smart lawyers who figured out a way to work around the issue by issuing out preferred shares.
Preferred shares are a lot like normal stocks, but Matthew Spiegel at Yale says they often lock companies into paying out regular dividends, and those dividends aren't tax deductible.
So generally, firms don't really like to have a lot of preferred stocks floating around.
Now, AMC's plan to convert its preferred shares into more common stock has a lot of investors nervous that the move will basically dilute the stock's value. But Jay Ritter at the University of Florida says the company likely wants to put this unusual stock situation behind them.
And just get back to being a normal corporation with common stock outstanding.
AMC's CEO said simplifying the stocks it offers will help it raise money more efficiently in the future. I'm Justin Ho for Marketplace.
And in New York, I'm David Brancaccio. The Marketplace Morning Report. From 8 p.m., American Public Media.